Hi everyone, and welcome back to Wealth Signals. If you are holding gold or silver right now, I know exactly what you're thinking. It's March 9th, 2026. We are waking up to the 10th day of a major conflict in the Middle East. Iran, Israel, the United States. This thing is escalating by the hour. Oil is surging past $100 a barrel. This is the exact environment where gold is supposed to shine, where it's supposed to be that safe harbor in the storm. So why on earth did we just wake up to blood-red candles? Why is gold down nearly 2.5% and silver getting absolutely hammered, falling over 4%? Let's just look at the numbers right now, because they are shocking if you haven't seen them. Spot gold tumbled as much as 2.5% in early Asian trading, briefly dipping below that key psychological level of $5,050 an ounce. At one point, we were flirting with a test of the $5,000 mark. Silver? Even uglier. Silver spot prices fell over 4%, sinking toward that $80.80 to $81.90 region. This isn't just a dip, this is a sell-off. And it's happening while global stock markets are sliding and while the situation in West Asia is getting worse by the minute. So what gives? Is the safe haven trade broken? Is the bull market over? Or is there something else going on beneath the surface? Today, we are going to break down exactly why this is happening. We're going to look at the fresh data points from this morning's trade, and most importantly, we are going to map out where gold and silver are likely heading next. Because if you panic right now without understanding the why, you're going to make a mistake. Let's start by solving the paradox. Why do metals fall during a war? The simple answer is that right now, the war is triggering a secondary effect that is toxic for gold in the short term, and that effect is surging oil prices. We are watching Brent crude jump as much as 17%, trading comfortably above $108 a barrel. WTI is flirting with $107. The market is terrified that this conflict is going to disrupt the Strait of Hormuz. If that shipping lane gets pinched, we are looking at a supply shock the likes of which we haven't seen in decades. Now here's where the dominoes fall. Spiking oil prices equals spiking inflation expectations. And spiking inflation expectations, in this current environment, do not mean the Fed is going to ride to the rescue with rate cuts. It means the opposite. Tim Waterer over at KCM Trade put it perfectly this morning. With oil at $110, the likelihood of rate cuts becomes far less certain. The market is now pricing in a greater chance that the Fed holds rates steady in June. Some are even whispering about the unthinkable, another hike if inflation really gets out of control. That repricing of interest rate expectations is hitting bond yields, with the 10-year Treasury climbing to a near one-month high. And what happens when U.S. yields rise? The dollar rallies. The Bloomberg Dollar Spot Index spiked 0.5% today. You see, gold is priced in dollars. When the dollar strengthens, it becomes more expensive for buyers in Japan, in Europe, in India to purchase. That kills physical demand. So right now, the inflation shock from the oil spike is creating a double whammy of a stronger dollar and higher yields, and that is temporarily overpowering the safe haven bid. It's confusing, I know, but the market is forward-looking. It's not just looking at the bombs dropping. It's looking at the economic aftermath. There's another piece to this puzzle that doesn't get talked about enough, and it's called a liquidity crunch. We saw this back in 2020 during COVID. When stock markets fall off a cliff, and they are falling right now, big institutional investors get margin calls. They need cash, and fast. So what do they sell? They sell their winners. And gold has been a massive winner this year, up nearly 17% year to date even after today's drop. They are selling their gold positions to cover their losses in equities. Joseph Thomas at MK Wealth Management called it profit booking, which is a polite way of saying that traders are cashing in their chips to stay alive in a market that is melting down. This is why you see silver getting hit even harder than gold. Silver is thinner, more volatile. When institutions need to raise cash quickly, they dump the assets with the highest beta, the biggest swings. And silver, down over 4%, fits that bill perfectly. It also has that heavy industrial component. If this war drags on and oil stays high, the market starts to worry about a global economic slowdown, which could dent industrial demand for silver in solar panels and electronics. That's the fear factor amplifying the move. Speaking of silver, let's zoom in on the charts for a second, because the technicals here are telling us a lot about where we might be headed in the very near term. Before today, silver had actually been looking pretty bullish, with analysts pointing to that long-term breakout above the old resistance zone between $50 and $54, which is now flipped to support. There was even talk of a hyperbolic phase, targeting $110 to $125 in March or April, based on time cycles and geometric projections. But here's the thing about technical analysis. Levels are meant to be tested. Right now, the immediate battleground is that $80 to $82 zone. We touched 80.80 earlier. If we get a sustained break below the psychological $80 mark, the next support levels aren't far behind. Technicians are looking at 79.50, and if that fails, we could see a retest of the 78.50 region. That's the demand zone. Manoj Kumar Jain from Prithvi Finmart noted that silver could hold support around $74 on a closing basis, but we don't want to test that unless we are in a full-blown liquidation event. But, and this is a big but, if you are looking at the weekly chart, the long-term structure is still intact. This sell-off, as violent as it is still a pullback within a bull market unless proven otherwise. The moving averages are still aligned bullishly, with the 50-day above the 200-day. The RSI on the daily is cooling off from overbought levels, which is actually healthy for the next leg up. So, while the short term looks shaky, the long-term trend is not dead. All right, so we've explained the what and the why. Now for the million-dollar question. What happens next? Where are gold and silver actually going to go? Because we can't just stare at red candles all day, we need a game plan. Let's start with the bear case, because that's what's in control right now. The bear argument, articulated by folks like Mark Chandler at Bannockburn Global Forex, is simple. If gold loses $5,000, the next stop could be $4,850. The thesis hinges on the real interest rate dynamic. If the Fed is forced to keep rates higher for longer, or God forbid hike again, because of this oil-driven inflation, then the opportunity cost of holding gold becomes too high. You'd rather be in bonds yielding 5% than in a rock that just sits there. eToro's Josh Gilbert called this the double whammy of dollar strength and rising yields, and he thinks it could be enough to offset the geopolitical risk premium for a while. If you are a bear, you think this correction has legs. But the bull case is far from dead. In fact, some of the smartest minds in the space see today exactly as a buying opportunity. Guys like Jesse Colombo and Adrian Day are calling this profit-taking, not a structural shift. They argue that the fundamental drivers, central bank buying, de-dollarization, the U.S. fiscal deficit, haven't changed one bit. And we got a massive piece of evidence for that bull case over the weekend. Despite the volatility, the People's Bank of China extended its gold buying streak to 16 months. Think about that. While retail traders are panicking and selling, the world's largest central banks are quietly accumulating. That is your backstop. That is the floor under this market. Looking ahead, the direction this week really depends on two things: the war and the data. The wild card is still the Strait of Hormuz. If that strait gets shut down, all bets are off. Oil could go to $150, and at that point, the inflation shock might actually trigger a full-blown economic crisis, which could force the Fed to cut rates to save growth. It's a chaotic feedback loop. Merrick's analyst Ed Meir summed it up best when he said, "There is a time to buy, a time to sell, and a time to simply wait. The latter is the preferred course of action for the moment." He's right. In the short term, volatility is going to be a nightmare. But the real decider, the thing that will dictate the next big move, is hitting us on Wednesday. That's when we get the U.S. Consumer Price Index report for February. This is the inflation data that the Fed will be looking at. If CPI comes in hot, the market will double down on the no rate cut narrative, and gold could drift lower toward that $4,900 area. If CPI shows inflation cooling despite the oil spike, we could see a massive relief rally as the dollar weakens. There's also the factor of physical demand that often gets overlooked during these volatile paper market moves. We are seeing reports from major dealers in Asia that physical buying has actually picked up this morning as prices dipped. In India, the local premiums have widened slightly, indicating that jewelers and retail investors are viewing this dip as an entry point. This doesn't stop a sell-off in the futures market, but it does create a buffer. It means that when the selling pressure exhausts itself, there is real, tangible demand waiting to catch the fall. Now let's talk about the dollar index in more depth, because this is really the puppet master right now. The DXY is hovering near 105.50, and technically, it just broke above a descending resistance line that had been in place since February. If the dollar closes above 106 this week, that's going to put immense pressure on all commodities, not just gold and silver. But here's the catch. The dollar's strength is largely based on the perception that the U.S. economy is stronger than Europe and Asia. If the war escalates and drags in U.S. troops or assets directly, that perception could flip very quickly into a flight to safety that actually benefits gold over dollars. It's a knife's edge. For silver specifically, we have to talk about the gold-silver ratio. That ratio has blown out again today. When gold was at $5,100 and silver at $85, the ratio was around 60. Now, with gold at $5,050 and silver near $80.80, the ratio has pushed towards 62.5. Historically, in a strong bull market for precious metals, that ratio should contract, meaning silver outperforms gold. The fact that it's expanding tells you that silver is being unfairly punished, which often precedes a sharp catch-up rally when sentiment turns. Contrarian investors watch this ratio closely. A spike above 65 could signal an extreme oversold condition in silver. We also need to consider the mining stocks, because they often act as a leading indicator. If you look at the GDX and SILJ ETFs this morning, they are down. But interestingly, they are not down as much percentage-wise as the physical metal in some cases. That divergence can sometimes signal that the smart money is starting to nibble. Miners are leveraged plays on the metal price, so if they start holding up better than the underlying commodity, it suggests that institutional investors believe the sell-off in bullion is temporary. Looking at the options market, there's been a flurry of activity in gold put options at the $5,000 strike for March expiry, but also significant call buying at the $5,200 and $5,500 strikes for April and May. This tells us that while traders are hedging against further downside this week, they are positioning for a recovery in the coming months. The volatility index for gold, the GVZ, has spiked, but it's not at panic levels yet. We're seeing elevated fear, but not the capitulation that often marks a bottom. Now, let's address the elephant in the room, the Federal Reserve. We have several Fed speakers scheduled for this week, and their comments will be parsed carefully. If they downplay the oil spike as transitory or unrelated to domestic demand, that could soothe rate hike fears. But if they sound the alarm on inflation expectations becoming unanchored, that hawkish tone could send gold lower. The market is currently pricing in a 70% chance of a rate cut in June, down from 85% just last week. That shift is exactly why we are seeing this pressure. There's also the technical factor of the 200-day moving average on gold. It's currently sitting around $4,780. That's a long way from here, but it's the ultimate bull market support line. As long as gold stays above that level, the long-term trend is up. The 50-day moving average is around $4,950, which is acting as immediate support. We bounced slightly off that level in early trading. Holding the 50-day is crucial for the bulls to maintain momentum. Geopolitically, we have to watch for any diplomatic moves. If there are signs of de-escalation, the oil premium could deflate quickly, taking some pressure off the inflation narrative and allowing gold to stabilize. But if we see further retaliation, particularly if Iranian oil infrastructure is threatened, then all of this goes out the window, and we are in uncharted waters. Energy traders are watching the tanker traffic data in the region like hawks, and any disruption will send oil, and by extension gold volatility, through the roof. So where does that leave us? If you are a short-term trader, you need to respect the levels. Watch $5,000 on gold and $80 on silver like a hawk. If those break, the pain could extend. But if you are a long-term investor, someone who understands that central banks are buying, that the US debt is unsustainable, and that geopolitical risk isn't going away, then days like today are just noise. They are tests of conviction. For me, the long-term thesis hasn't changed, but this week, we let the data guide us. We watch the war headlines, and we circle Wednesday's CPI report on the calendar. I want to leave you with this thought. The markets are emotional. They swing from fear to greed and back again. Today, fear is in control, but it's fear of inflation and rates, not fear of the conflict itself. Once the market digests the oil shock and realizes that central banks aren't going to stop buying gold at these levels, we could see a very sharp reversal. The question is simply one of timing. Are we there yet? Probably not. We likely need to see the selling exhaust itself, which might take another session or two. But for those with cash on the sidelines, this is exactly the kind of volatility you wait for. You don't buy when everyone is euphoric. You buy when there's blood in the streets, even if it's your own asset class bleeding. Just remember to size your positions appropriately and leave room to add if we go lower. This is not a time for reckless gambling. It's a time for disciplined accumulation if your thesis remains intact. I hope this breakdown helps you navigate the chaos. We'll be watching the levels closely, and we'll be back with a full analysis of the CPI report and what it means for the Fed's next move. Are you buying this dip, or are you waiting on the sidelines until we get the CPI report on Wednesday? I want to know your strategy. Is this a buying opportunity for you, or does it feel like a falling knife? Comment below.